Welcome, everyone, to our podcast today. Today's episode, we're going to be discussing top tips for year-end tax and financial planning. And I'm here today with my colleague, Phil Druin, and my name's David Burney, and we're both certified financial professionals at Ryan Lamontagne in Ottawa. Phil, what do we got on the menu today?
So we've got a few different topics. We're going to be speaking about some key deadlines, mostly in regards to different investment accounts, so registered retirement savings plans, registered education savings plans, registered disability savings plans, the tax-free savings account, and all those fun accounts. We're going to discuss key deadlines on trading and some benefits to that, and also just some ad hoc tax tips that may be relevant to different taxpayers.
I think the first topic will be key deadlines. A few of the ones worth mentioning are going to be the last trading day, why that's important, the last days for contributions to registered plans like TFSA, RSPs, and RESP, why that's important, and just final year tax planning, topics like charitable contributions or donations before year end, how to maximize that, and some topics all around year end tax and financial planning.
Yeah, so Phil, what are the last trading days of the year, and why does that really matter? Why do we care?
So typically the last trading day of the year, although you may not want to wait till the last trading day, is the last business day of the calendar year. Why that's important when it comes to tax planning, it can be circumstantial depending on your financial situation, but in some situations it may make sense to trigger some losses or some gains when it comes to the security selling. There are some benefits to triggering a gain in 1 year compared to the next year. You may have lower income in 1 year, or you may want to spread out the gain over multiple years. So doing that prior to the end of the fiscal year is important. And again, I think on the loss side, you can have some advantages to triggering some prior to the end of the year.
Yeah, that's right. If you have capital losses, essentially, as many of you may know, you can offset that against a taxable capital gain. But there's something you need to be wary of. If you have a loss in a position and you trigger that loss, you've got to essentially wait 30 days plus 31 days before you can buy the security back. So if you bought security X at $10, it's now trading at $8, and you want to trigger that loss to offset against a gain from another transaction earlier in the year, you can go ahead and do that. As Phil said, there's a deadline. You need to do it within the calendar year before the end or on the day of the last trading day. And though, if you really like that security, you see prospects for it growing, you can't buy it back immediately. You can't buy it back on January 1st. Otherwise, you have a special type of loss called a superficial loss. And we won't really go into that today, but just be aware that's something that you should speak to your financial planner about, because losses and triggering those losses are quite important. And buying back the security may also be important. You just don't want to lose access to the loss.
So you can do some year-end planning by triggering some losses. You don't always, or it's never really a good thing to have a capital loss, but you can use that maybe to your advantage to pay less taxes in the future.
Yeah, and you can offset that, again, as I said, against any taxable capital gain. It doesn't have to be from a security. It could be from another capital gain. Maybe you sold a cottage or whatnot, another asset that produces a gain. So those net capital losses can be used to offset that. And the other thing, you can use a capital loss that you incurred this year, an allowable capital loss, say from a security that you sold, and you can offset a gain from the last 3 years. You can carry it back 3 years. And that's important because you may have a loss and it's unfortunate, but you may have had a large gain last year, or maybe the year before, or even the year before that. And that loss from this current year can be used to offset a gain from a previous year for the last 3 years. You can also bring the loss forward and be used to offset a capital gain in the future. So that's an important consideration with respect to gains.
So you're saying that if you have a loss, you can trigger the loss, bring it back to your previous tax year and get a large tax refund?
Yeah, you get a relief of taxes, It's done. You can claim the loss on your tax return using a Form T1A, or you can even file an adjustment if you'd like to. But most people do it on the T1A form, and CRA will reassess you for that particular year that you're claiming the loss for, if it isn't the current year. And it's important to note, first of all, capital losses have to be used. You must use an allowable capital loss in the current year. It's only unused losses that can be carried back or carried forward. So if you had a loss that exceeded your gains for the year, or you had no gains this year, you can carry those losses back, and CRA will reassess you for that particular year. And you can carry some back to last year, the year before, or as I said, even the year before that. It's up to your financial planner to help you decide what's best for you and optimize your tax relief from CRA.
So it sounds like discussing with your financial planner in terms of tax preparation and some tax strategies can really be helpful in saving some taxes. There's a few other deadlines that perhaps you're more aware of. Some different strategies. There's the topic about RSP contributions. That's always at the top of people's mind when it comes to taxes. Naturally, if you make a RSP contribution, you can reduce your taxes. There is a deadline to making those contributions. Now, it's not at the end of the fiscal year. You actually get a bit of leeway. You get 2 months post end of fiscal year to make those RSP contributions that you can use in the prior fiscal year. There's RESP contributions, RDSP, so Registered Disability Savings Plan and Registered Education Savings Plan. You want to make sure to make those contributions to really take advantage of the grants and contributions and matches on your contributions from the federal government, which can be quite substantial. Most of them can be carried forward to the next year, but again, there are some maximum allowable matches for grants that is best used up in the current year as opposed to carrying it forward. So those are, again, some of the contribution deadlines that are important to really remember when it comes to registered plans. There's also the tax-free savings account. Now, the tax-free savings account is a bit of a tricky one when it comes to contributions and withdrawals.
Yeah, you want to be careful with the tax-free savings account. A lot of people are aware that with your RRSP, your Registered Retirement Savings Plan, you can overcontribute up to $2,000 at any point in your life. You can't do it every year. It's got to be at any given point in your time. You can be overcontributed and you won't be penalized. But we can tell you from experience and from preparing.
But there's a maximum for that, right?
Yeah, $2,000
Right.
lifetime. But we can tell you, we prepare a lot of tax returns here at the firm, and I can tell you that if you overcontribute by $100 in your TFSA, you're going to get a letter from CRA, and they'll warn you the first time, and then the second time in your TFSA, if you're overcontributed, they'll actually penalize you, and it's 1% of the overcontribution per month. And that's a nasty thing. And a lot of people, what they do is they rely on the CRA website to give them the current information about their TFSA. When you file your tax return, you get a notice of assessment. And a notice of assessment is going to tell you what your RRSP limit and deduction is going forward. So it's there in black and white. It's very easy to figure out. They give you the number. And so you say, if it's X, you put in X for the following year. Simple. They don't do that for TFSAs, okay? And it's a long story why they don't, but essentially they don't. So you can go to your online account at CRA and you can see what your limit is. The problem is they don't update that until February or March of the following year. So even just today, I had a client remind me to contribute to their TFSA on their behalf. And I reminded them that we had already done that in April. And he said to me, but CRA says I have a $7,000 limit, the current limit for this year. I said, it's already been done. That won't be updated until the next year. And so that's something you got to be careful of. And you need to make sure that you and your financial advisor are on the same page when it comes to that.
So along those lines, in a scenario where I want to withdraw out of my TFSA just for the short term, but then I want to contribute it back to my TFSA, is there a timeline where I should be looking at doing that?
That's right. So let's say we're at the end of the year, or at any time during the year, you decide to withdraw some money from your TFSA. Many people know that one of the benefits of a TFSA, it is truly tax-free. Unlike an RRSP, it's just tax deferred. you're eventually going to pay tax on that money. You just defer the tax until the year of withdrawal. But in the TFSA, it is truly tax-free. It's a fantastic vehicle. And so people will withdraw money from their TFSA, and they know well enough that they're allowed to put that back in. So if your TFSA has grown and you withdraw the growth out of it, or the principal, doesn't really matter. You take some money out. Most people know you can put that money back in, but you can't do it until the following year. And, a lot of people don't know about that. They'll withdraw the money in September for a large purchase or whatnot, and they'll put the money in December or something. And it's like, you're offside, you're over contributed. You got to wait till the following year. So the following year, you can put that amount that you took out, in my example, in September, plus the new contribution for the,
Or else you get a letter from CRA
or you get a letter, or worse, you get a penalty.
or a bill.
Yeah, you get a bill.
So there's also some very generous people that like to make charitable contributions to their favorite organizations. Can that help you tax-wise?
Yeah, for sure. In Canada, we have very generous donation laws, and it's all involved within the Income Tax Act. I mean, essentially, without getting into too much details, you can donate 75% of your net income in any given year. So if you donated more than 75% of your net income in a given year, as some people do, then you can then carry forward the excess over the next 5 years. I mean, that's an unusual thing. You don't see that every day. And we could do a whole presentation, a whole podcast with respect to donations. But what I'll say here today is that you want to make sure you get your donations in before the end of the year. Get that donation receipt dated this year. And therefore, they can then be claimed. A lot of people call it a deduction. It's technically not a deduction. It's a tax credit, but, we're mincing words. It's very generous. There's on the first $200 that you donate, you get a relatively low amount of tax credit for that, tax relief. But anything over $200, you get far more tax relief, up to the highest marginal tax rate. It's very generous. And, depending on the province you live in, the province will match you as well. Here in Ontario, recently, the current government has lowered the amount that they give in relief, but it's still quite generous. And so if you donate, say, $100 a year, and that's your thing, perfect. You can choose not to claim that credit this year. It's not written in the Income Tax Act that you can do that, but CRA administratively allows it. And so let's say you donated $100 this year, $100 next year, $100 a year after that, etc. You could save up those donations. And in theory, in my example, you would have $500 donated after 5 years. You could then make one big claim on your tax return for $500. Now, you've got to look at different scenarios. Was it worth it to carry it forward 5 years? It depends on the amount. It depends on many things. And that's something that you want to discuss with your financial planner professional. So it's something that you should be aware of, but get the donation in this year, get this tax slip for it. There's no rush to claim it right away. Talk to your financial planner and they'll discuss with you whether or not you should carry it forward or not. The other thing that they allow you to do is they allow you administratively to have, if you have a spouse, to have your spouse claim the donation. So even maybe you make some donations, maybe your spouse makes a donation, and the total comes to $500 this year. You did $200, your spouse did $300. Instead of each one of you claiming $200 and $300, you'll get a much bigger credit for the household if you just claim the $500 on one return. And again, that's something else that your planner can look at. And it's an essential part of tax planning. It's one of the few things that you can do at tax time to prepare or to
Lower your taxes.
to lower your taxes.
Yeah.
There's not a lot you can do when you're filling out your tax return. The tax year is over, but that's one of the few things that you can do, decisions that you can make at the time, whether or not you're going to claim it.
And most people tend to donate cash, which, is the normal way to distribute funds to your charitable organization of choice. But you're also able to actually donate securities. And in some cases, it may be worth donating securities that are at a gain or a large gain. There's a double-ended benefit where you can actually avoid paying taxes on the gain, and you get to claim a credit, on your donation as well. So again, that's where the planning comes into place. That's not something that you can just do ad hoc. Typically, there's some planning involved, which securities to donate, especially if you're someone that likes to make larger donations to organizations. So those are all stuff that can really be planned over time or over years.
Yep, that's right. That's a massive benefit, not having to claim the capital gain on a security. Normally, when you dispose of a security, if it's in a gain position, there's a tax event that's occurred. But with a security, there's some fancy stick handling that can be done on the tax return. The gain is avoided, and you also get the credit. So you supersize your tax credit for an initial contribution. Like you may have bought a security at $5. It's now worth $25. Well, it only costs you $5 a share, but you're giving it away at $25, and you're getting the credit for it at that, multiplied by the number of units that you have, and not paying the tax on the gain. So it's a great strategy for some people, and it's something that you want to speak to your CFP professional about for sure.
And how about some tax tips for our great small business owners?
Yeah, well, that's a loaded question. We could do a whole podcast on that, maybe a whole series of podcasts, but some quick ones. I mean, especially if you're a sole proprietor and maybe you're buying some equipment, and you're thinking about buying some equipment for your business, you could seriously give some thought to buying it before year end. And the reason being is because if you have an asset that's helping you to produce income for your business, that's depreciable. You can claim capital cost allowance on that. And we won't get into what the different classes are for different assets, but essentially you depreciate the asset over time and you get to claim an expense against it. But they have a special rule called the half-year rule. And what happens is if you buy an asset, say in January, well, even though you've used it for the whole 12 months of the year, you can only claim half of the capital cost allowance that you would normally be entitled to. So if you were going to buy the asset anyway, and you've been thinking about it, buy it. It could be anything. It could be an office chair, a computer, a desk, something bigger, a piece of machinery. Buy it in December, let's say, because then you'll get the half year over with in the current year, plus it'll be prorated just for 1 month, but you don't really care because you'll get the full years worth of depreciation in the following year and the year after that. So that's a common one because especially a lot of small business owners, they have some small capital expenditures that they've been thinking about, whatever it may be, get it at the end of the year and as opposed to January or February. The other thing you might think about if you're incorporated, again, we could do a whole podcast on that. Should you pay yourself a salary or a dividend? Maybe you should defer some of your salary, or maybe you have a large capital gain this year and you have the ability not to defer your salary into next year. That's also possible. And that's something that you need to speak to your financial planner about because salary deferral is not something a sole proprietor can do, but an incorporated owner-manager of a closely held corporation can definitely do that. But again, there's a number of things that we could discuss here, but those seem to be the common ones that clients come to us with. Should I defer my salary? Should I pay a dividend? When should I be buying this capital asset? That type of thing.
Because as a corporation, it's not necessarily always right to just pay yourself a dividend, right? A salary can actually be much more beneficial when you're working.
Correct. If you were to pay yourself a $100,000 salary or a $50,000 salary versus a $50,000 dividend, believe it or not, the tax is almost the same because a dividend is paid after the corporation pays tax. So even though you may be a small business and you qualify for what's called the small business deduction, the amount of corporate tax you pay would be quite low, maybe in the 11-12% rate, depending if you have business partners or not and you're sharing in the deduction. We won't go there today. But you might be paying a low rate of tax, but then you've got to pay tax on the dividend personally. And your first, you may have heard or read something out there where the first $40,000 of dividends, if you have no other source of income from the first $40,000 of dividends from a private company are tax-free, if you have no other source of income. That is true. Most people have other sources of income, but if they didn't, that would be true. But the corporation paid tax at 11 or 12%. If you were to instead pay yourself a $50,000 salary, Well, then that's deducted from the corporate income statement, and that's an expense to the corporation. So the corporation doesn't pay tax on that, but you then pay tax on the $50,000. But you qualify for your basic personal credit, the employment credit. When you work out the tax, you're only paying about the same amount of taxes you would if you paid a dividend as a household, So it's
And you get RSP contribution room.
with a salary, yeah. So that's my next point: is you get RSP contribution room. A dividend does not give you that. You also contribute to Canada Pension Plan, which some people don't want to do, and that's why they pay themselves a dividend. We won't go there today, but some people do want to pay into Canada Pension Plan. You end up paying twice. You pay on behalf of the employer because you are the employer, and you pay on behalf of the employee. And so there's some debate whether or not that's what you want to do. But that can easily be modeled.
But no one complains when they collect CPP.
Yeah, nobody complains when they collect it. But at the end of the day, it's about forecasting and projections, and that's something that your financial planner will do for you. But there's no clear, massive benefit to paying one or the other until you get to the very high rates of tax. Then there is a bit of a benefit to paying a dividend, perhaps. But other than that, people ask all the time, salary or dividend. If you want to put money into an RSP and you want to pay into Canada Pension Plan, then you pay yourself a salary. Again, you have to be incorporated to do this. A sole proprietor has no choice. And then if you don't want to do those things, then you may look at paying yourself a dividend.
So again, I think the theme is planning. You got to plan for what you want to do, how much your expenses are, how much money you actually need, and where those sources are going to be. Cash flow planning long term, whether you're working or if you're retired, there's different circumstances. So those are all kind of questions and answers that your financial planner can definitely help with when it comes to.
Yeah, if you're already retired, a lot of people pay themselves a dividend because again, they may not have any source of income at the moment other than this dividend. They may be not collecting CPP at the moment or old age security, or they may be deferring it. They pay themselves a dividend. Your first $40,000, if you have no other source of income, is tax-free from a private company. From a public company, it's higher, but we're talking about the owner-manager of a small company. And if your spouse is a shareholder too, as long as you follow the rules, and there's quite extensive rules out there, then the dividend that is paid to them would also be tax-free on the first $40,000, essentially to them personally. Some people, when they retire at the end of the year, or the year following the year that they retire, and they're not drawing a salary anymore from the corporation, they'll still draw a salary. And there's all kinds of potential to do a carryback. But again, that's within the corporation to create a loss and get a tax refund. But that goes way beyond what we're going to talk about today. But again, these are things that are important, and they're everyday events that affect our clients at the firm.
If you haven't noticed, Dave can talk for days about taxes.
Yeah. I'm an exciting guy at a party, I'll tell you. So, Phil, what about our good clients who are turning 71 this year? What special considerations do they have to take into account?
So first off, turning 71, so there's a few considerations. The main one is regarding RSP. So if you've accumulated funds in your RSP over the years, you've made contributions, then at the year that you turn 71, unfortunately or fortunately, you have to actually convert your account into what's called a RIF, a retirement income fund, and you have to start withdrawing from that account in the next calendar year. Now, in some circumstances, you may still be working. You might have higher income still, might have rental income, rental properties, and even though you're getting into your 70s, you might still be near your peak earning years and earning a lot of money. So you're probably looking at trying to reduce your taxes as much as possible. Now, one way to do it would be through RSP contributions. Now, you might think, well, I'm converting my RSP into a RIF. I can't make any more RSP contributions, which is true. You cannot at 72. You cannot make any more RSP contributions because you no longer have an RSP. But what you can do is front load your RSP contributions if you do have room, which means that, for example, if you have a $50,000 contribution room remaining at the end of your the year you're turning 71, you could make a lump sum contribution and actually deduct that in future years. So you could deduct it next year, you could deduct a portion of it next year and keep some for the years going forward. So there are some planning tips that can be involved in terms of making those extra contributions. Not to get too much into detail, but as Dave has mentioned, you can actually over-contribute by $2,000, so you could do that and then have that room in future years. So again, it comes to really looking at your circumstances and perhaps taking advantage of some tips and tricks of making contributions prior to converting your RSP into a RIF once you turn 71.
Yeah, and what's the benefit if, let's say you're 74 and you can't have an RSP anymore, as you itemized, but what if your spouse is 68? Can you still make an RSP contribution?
So that's a good one. You can, obviously not to your own RSP because you don't have one anymore. But as Dave has mentioned, if you have a spouse that's younger than you, younger than 72, in this case, you can actually make a spousal contribution, which would go into your spouse's RSP account, but the deduction goes on your own tax return, your personal tax return. So although you are over the age limit of being able to make RSP contributions to your own, you could allocate those contributions to your younger spouse. And in that case, you'd be able to actually use it against your own income, which is, again, not in every circumstance that people would fall into that. It may not be worth it for some people. But it is a tip if you're still making higher income in those years, and you are in a situation where you have a younger spouse to take advantage of that.
Yeah, and especially if you have rental income. A lot of people are unaware that if you have net rental income, so you may be long retired, but you've got some rental properties or a rental property, or even it could be an Airbnb, it could be business income. That's considered earned income for RSP purposes. So you would look at your notice of assessment after declaring that income on your tax return, and you'll notice your RSP contribution limit goes up. And you're like, why are they doing this for me? I'm 74 years old. I can't contribute to an RSP. Well, as Phil just itemized, yes, you can if your spouse is younger. Or even if you're, as he said, if you're 71, you're turning 71 this year, you want to make sure you get your RSP contribution in before the end of the year. Don't wait till February, because in February of the following year, your RSP is no longer around. It's been converted to a RIF. So in the current year, if you are turning 71 this year, you have to convert. You have no choice. The institution will do it for you, whether you like it or not. They're going to convert it to a RIF. Make sure you get your current year's RSP contribution in there before that's done, if it makes sense for you. But again, that's something you've got to discuss with your financial advisor. Well, this concludes our episode for today, Phil. We had a lot to talk about. We've got a lot more to talk about. Stay tuned for the next episode. The big takeaway for you today is that planning is a process. And Eisenhower once said that plans are useless and planning is everything. It's very true. At least with a plan, you have a start point and you have an end point, but the stuff in the middle changes all the time. And that's why it's important to speak to your qualified financial advisor. At our firm, we're all certified financial planner professionals. We work in teams, and we specialize in fee-based financial planning. So, Phil, any last parting remarks?
No, not really. We obviously touched on a lot of the things. If there's any other further questions, feel free to reach out through our website, and we'll see you next time.